Hi everyone, welcome to this webinar on crypto regulation. My name is Thais Cruz and joining me today are my esteemed colleagues Brian Flood and Pierre Simon. The absence of crypto regulations leaves investors without the same safeguards as licensed banks or brokers. What is the link between crypto and traditional banking? Are stricter regulations really necessary? Or does it go against the whole decentralization concept? Today, we'll explore the current status, the benefits, and potential drawbacks of regulation in the crypto industry. During our discussion, we encourage you to share your thoughts and opinions in the comments area. Your perspective is valuable to us, and we look forward to hearing your insights. At the end of the webinar, we will have a Q&A where we will try to address all your comments and questions. So let's get started and delve into the fascinating world of cryptocurrency and regulations. I will now pass the floor to Brian.
Good morning, good afternoon. Thank you for joining us, and thank you, Thais, for the introduction. The month of April 2022 brought great success for Terra USD. On the 5th of April last year, Luna's token price reached an all-time high of $119, making it the third largest stablecoin in the world. Everything seemed to be going smoothly for Terra USD. However, in less than a year, it went from being one of the biggest stablecoins to effectively being worthless. Terra USD, once a major stablecoin, crashed and lost a staggering $40 billion in value in just a few days. 6 months after the unfortunate events of Terra USD, cryptocurrency exchange FTX began experiencing its own financial difficulties, eventually leading to Chapter 11 bankruptcy. The catalyst was a revelation by crypto news site CoinDesk that Alameda Research, a quantitative trading firm run by Bankman-Fried, held a $5 billion position in FTT, the native token of FTX. This report raised concerns within the cryptocurrency industry about the undisclosed leverages and solvency of Bankman-Fried's companies. The value of FTT plummeted by over 80% in just 2 days, causing panic among investors and triggering a bank run that exposed an $8 billion hole in FTX accounts. It was a shocking revelation that exposed one of the biggest financial frauds in American history. The crisis faced by the cryptocurrency sphere had a knock-on effect, spilling over into the world of traditional banking. We can observe a link between the collapse of FTX and the subsequent bankruptcy declaration of major banks in the United States. In March 2023, 2 significant banks failed. The first was Silicon Valley Bank, known for its focus on serving tech companies and individuals. The uncertainty surrounding FTX in the days leading up to its bankruptcy triggered a bank run that SVB couldn't recover from. In just 1 day, clients reportedly withdrew $40 billion from the bank. Shortly after SVB's collapse, Signature Bank, which heavily relied on cryptocurrencies, faced prospect of closure. In 2018, Signature Bank shifted its focus to accommodate customers in the cryptocurrency industry, and by August 2022, over a quarter of its deposits were in cryptocurrencies. By early 2023, Signature Bank had become the second largest provider of banking services in the cryptocurrency industry. However, it too fell victim to the uncertainties surrounding FTX, which led to a bank run from which Signature Bank couldn't recover. Another bank affected by the collapse of Terra USD and FTX was Silvergate Bank. In 2017, Silvergate expanded its assets by serving crypto exchanges and other crypto-involved companies that struggled to secure financing from larger banks. Shortly before its collapse, at the end of the fourth quarter of 2022, 90% of the bank's deposits were crypto-related. The collapse of FTX caused widespread panic in the crypto industry, triggering a bank run that Silvergate couldn't overcome. Within a couple of months, three major supporters of cryptocurrencies collapsed, leaving the crypto industry facing an uncertain future, largely due to its own actions. This series of events emphasizes the need for increased regulation in the crypto landscape to protect investors. The absence of regulations leaves investors without the same safeguards as licensed banks or brokers. The speed of digital banking withdrawals and the amplification of panic through social media raise concerns for future cases. Stricter regulations are necessary to prevent potential economic disasters resulting from significant bankruptcies of cryptocurrencies and banks.
Cryptocurrency stands at a critical juncture where the future trajectory of the industry greatly depends on the implementation of regulations. Addressing the numerous questions and concerns surrounding cryptocurrency is vital to bringing stability to this evolving landscape. Over the past 18 months, the volatility and risks associated with crypto assets have become evident, particularly in the absence of fundamental safeguards. Major cryptocurrencies have witnessed substantial value decline since 2021, with Bitcoin, the largest cryptocurrency, losing 3/4 of its value. As a result, the current outlook for cryptocurrencies appears uncertain, and it's also uncertain if they will ever regain the heights achieved during the 2021 peaks. Cryptocurrencies are at a pivotal point where the implementation of regulation will have a profound impact on their future. To ensure the stability and growth of the industry, it is necessary to address concerns by strengthening financial regulations, promoting supervision, and establishing consistent global standards that regulatory authorities can actually enforce. So the question pops up, is regulation a good thing? Well, let's explore a few benefits. Firstly, more stability in the market. Regulatory guidance, if well targeted, could help reduce speculation among crypto assets. Less speculation can lead to higher investor confidence, which could draw in more long-term investors who have so far said no thanks to a highly speculative, volatile crypto market. It's hard to predict how the price-sensitive asset class will react to the regulation over the long term, since it depends on whether governments take a more lenient or stringent approach. In the short term, any new regulation could inspire knee-jerk investor reactions to the markets, suppressing the trading values of cryptocurrency. For example, when China banned cryptocurrency transactions in September 2021, cryptocurrency markets dropped immediately. But over the long term, regulation has the potential to stabilize the market and reduce some risk for cryptocurrency investors. And looking at increase in investor protection and confidence. So crypto investors currently have little to no protection in the market, as there is no regulatory framework in place to ensure any protection of assets. Regulation can change this. Crypto will still likely be a risky investment, like individual stocks, but investor protections could make the market less vulnerable to outside manipulation. Safer markets can also lead to more investor confidence, which often means greater value over time. Safer crypto ecosystem. SEC Chair Gary Gensler described crypto as the Wild West due to the lack of regulation in the industry, which has created an opening for widespread fraud, scams, rug pulls, and market manipulation. Crypto crime has grown tremendously over the last 2 years. Scammers took $14 billion worth of crypto last year, a record compared to the $7.8 billion taken by scammers in 2020. According to a report by blockchain data firm Chain Analysis. And there are more than 70,000 altcoins, which are typically even more volatile and speculative than Bitcoin, and come with a higher risk of crypto scams and frauds. Even the most advanced and enthusiastic cryptocurrency experts understand that there are many new and evolving risks in the world of crypto right now. So, After talking about the good things that regulations can bring, let's mention some of the frequently hard arguments against regulation. Please write your thoughts in the comment area. We love to hear your angle on these statements, specifically the ones against regulation. So let's look at the first. It goes against the spirit of crypto. The core of cryptocurrency culture is the decentralization concept, which eliminates middlemen like large banks and governments from financial transactions. It also deprives the banks and companies of their authority and gives people the freedom to manage their finances independently. Simply said, regulation runs counter to this notion. Another argument, it will damage innovation. Blockchain technology's potential to upend numerous industries, particularly finance, has contributed to the cryptocurrencies industry's recent success. Due to the absence of centralized networks and infrastructure, these enterprises' startup costs are frequently significantly lower. However, the sector is also prospering as a result of the adaptable fundraising strategies. Companies that use cryptocurrencies have been able to raise money fast without being constrained by onerous security regulations. Additionally, small-scale investors have had access to projects that they otherwise would not have been able to access. Let's look at the third argument against regulation. It will drive down the crypto market. It does not appear realistic that the United States will attempt to follow China and outright outlaw cryptocurrencies. But because so many people are afraid of it, tougher regulation would almost surely have a short-term negative impact on prices. In the world of cryptocurrencies, regulation itself has taken on a certain specter. As a result, cryptocurrency values decline despite reports of significant governmental action. It's important to note that some expert content regulation would, over time, have a favorable effect on prices. For instance, money from significant institutional investors may eventually more than outweigh any short-term loss of illicit funds. And regulation that builds trust and adds a level of investor protection would help the industry to grow even further.
Thanks, Pierre. What probably matters the most in the end is how any new cryptocurrency legislation is structured. Regulators should exercise restraint to avoid severely impeding the operations of genuine initiatives. However, sensible regulation that eliminates bad actors might foster an environment where sincere ventures can succeed. Let's take a look at the regulations that have been put in place. There are no global regulations. It's usually regulated at a national level. However, there are organizations that have set up guidelines for regulating crypto. These organizations may vary in size, membership, and objectives, but all share the common goal of promoting regional integration and cooperation among their member states. A few examples are the African Union, the Association of Southeast Asian Nations, and the Pacific Alliance. These international organizations are not responsible for making laws, like one other unique organization, the European Union. The EU has recently been focusing on crypto regulation, as Brian already mentioned. In April 2023, the EU adopted the MiCA regulation. The MiCA is short for Markets in Crypto Assets. It has a big impact on crypto asset service providers. Some important changes for CASPs are that they require authorization to operate within the EU. CASPs with more than 15 million active users are classified as significant and will therefore be supervised by competent authorities. And the ESMA, European Securities and Markets Authority. The ESMA can intervene to limit the provision of crypto asset services by a CASP. In addition to the MiCAR, the European Parliament voted to extend the Transfer of Funds Regulation, the TFR, to crypto asset transfers as part of the EU AML CFT legislative package. This extension of the TFR is assigned to be applied together with the MiCA regulation. The TFR, which has been implemented since 2015, aims to prevent payment systems from being used to launder money or finance terrorism. As we all know by now, the crypto platform is also used for criminal activity. With the CASPs also under the scope of this regulation, they have to meet certain requirements. In Europe, they must accompany transfers of virtual assets with information on their originator and beneficiaries. This information must be obtained, held, and shared with their counterpart of the virtual asset transfer and must be available on request to competent authorities. Transfers involving CASPs and non-obliged entities, like self-hosted wallets, are also under the scope of the regulation, with their own specific requirements. Let's also take a look at what the United States is doing. So far, the US has taken a hot and cold approach to regulating crypto. Some in Congress would like to see a comprehensive new framework put in place that would allow the industry to thrive, while financial markets regulators have their concerns regarding money laundering, scams, and cybercrime. The Biden administration signed an executive order in March 2022 that called on federal regulators to assess the broad risks and benefits offered by cryptocurrencies. In January 2023, it released a roadmap to mitigate crypto risks, which encouraged regulators to ramp up enforcement and for Congress to expand regulators' powers. While the statement does not prohibit banks from providing crypto services, it does state that the crypto assets that are used, issued, stored, and transferred on an open public or on a decentralized network is highly likely to be inconsistent with safe and sound banking practices. The crypto market is regulated by several government agencies on the federal level and by local regulators on the state level. The US Federal Reserve, a primary organ regulating banks, also regulates only bank-issued digital currencies. The Federal Reserve requires US banks to disclose the assets behind their cryptocurrencies. Any new activity regarding these assets should be reported to the Federal Reserve. Other bodies regulating cryptocurrencies in the United States include the Securities and Exchange Commission, the SEC. This commission regulates the stock market and other investments. Cryptocurrency is a security, in some cases at least. Some crypto assets providers have to compile a stack of SEC rules and regulations. Whether or not an asset may be considered a security is defined by a Howey test, a document which is more than 100 years old. According to this test, Bitcoin and Ethereum are not securities and do not fall under jurisdiction of the SEC. Another regulating body is the Financial Crimes Enforcement Network, the FinCEN. This body serves to prevent and identify financial crimes. They monitor cryptocurrencies in order to detect financial crimes such as Commodities Futures Trading Commission, the CFTC, regulates futures and commodities trading. Several cryptocurrencies fall under this category, so their providers are obliged to comply with the corresponding set of CFTC rules. Internal Revenue Service, the IRS. This federal body is responsible for tax collection. The IRS views cryptocurrencies as property. If crypto assets are held for more than a year and profits are derived from them, then they are subject to income taxes. This obliges any organization involved with crypto trading to keep records, which admittedly can be very burdensome. And finally, the Office of the Comptroller of the Currency, the OCC. The OCC is responsible for the supervision of the federal banking system and determines the cryptocurrency offerings, as well as the process of applying for banking licenses for the fintech and other companies. As mentioned before, there are also state regulations, most of which are aimed at creating a favorable climate for crypto-related activities. Some, however, are restricting. For example, the New York State moratorium on the use of fossil fuels for cryptocurrency mining. It is also obvious that both state and federal law to evolve over time and adapt to changing tech and business landscape. Let's also take a quick global look. We have the Central African Republic and El Salvador, who adopted Bitcoin as a legal tender, whereas China banned all cryptocurrency transactions. In Canada, exchanges have essentially been regulated similarly to conventional money service businesses since 2019. But the regulatory landscape in Canada is often viewed as stricter than their American cousins. FTX and Binance, for example, both pulled out of the Canadian province of entirely in 2021 due to the extensive regulatory demands. Overall, the global crypto regulations vary from country to country, but more jurisdictions are implementing the FATF travel rule, including Lithuania, the United Kingdom, and Switzerland. It is expected that more countries will follow. I will now pass the floor back to Brian.
Cryptocurrencies are known for their independence from central authorities, theoretically safeguarded against government interferences or manipulation. However, the paradigm is gradually shifting as governments in the US, the European Union, and the UK are taking action to clean up the market and implement regulations. Establishing inclusive regulations will benefit the crypto industry by demonstrating that policymakers are adopting a long-term perspective rather than merely reacting to short-term market fluctuations. The implementation of increased regulations by regulators can serve as a lifeline for cryptocurrencies, ensuring their stability and fostering their growth. Looking at the US, bipartisan banking legislation introduced in 2018 relaxed restrictions and oversight for banks with assets below $250 billion, while imposing higher standards on mid-sized banks. This change enabled those banks to operate with reduced regulatory scrutiny, influencing their risk approach. In Europe, regulators brought cryptocurrency regulations under the Pure View in 2018 through the fifth AML directive. This directive aimed to address issues related to money laundering, tax evasion, and fraud in the cryptocurrency realm. As regulatory measures continue to expand worldwide, it is anticipated that more rules and regulations will be introduced for the crypto space. However, there is still a lack of clarity and unified approaches among governments, leading to disparities within the crypto sphere. Some countries, such as Malta, have developed specific laws for cryptocurrencies and blockchain technologies, while others are striving to adopt existing rules. This raises the question of whether this emerging economy, which is gradually impacting various industries, should have its own distinct legal framework. Ideally, a global approach involving all stakeholders should be developed to provide the crypto market with a cohesive regulatory structure. The crypto industry has faced a challenging 18 months, largely due to its own self-inflicted issues. However, many of the concerns stemming from this crypto downturn can be addressed by strengthening financial regulations and supervision, as well as establishing consistent global standards that national regulatory authorities can implement. Cryptocurrencies are currently at a crossroads, and the impact of regulations on their future cannot be underestimated. There are numerous questions and concerns that must be addressed in order to stabilize the world of cryptocurrencies. The past 18 months have highlighted the volatility and risks associated with crypto assets when basic protections are lacking. Major cryptocurrencies have experienced significant losses since 2021, with Bitcoin, the largest cryptocurrency, losing 3/4 of its value. The future of cryptocurrencies currently appears to be uncertain, with the possibility that it might never regain the heights that it experienced during its 2021 peak. Strengthening financial regulations and supervision and developing consistent global standards that national regulatory authorities can follow are crucial steps in addressing many of the challenges facing cryptocurrencies. Fortunately, there are positive aspects that could shape the future of cryptocurrencies. The IMF believes that targeted restrictions yield better policy outcomes, provided there is sufficient regulatory capacity. Policymakers are closely monitoring the ups and downs faced by cryptocurrencies, demonstrating their attention to the matter. Implementing appropriate regulations indicates that policymakers are taking a long-term view rather than reacting solely to short-term market fluctuations. And this will help ensure the long-term viability of cryptocurrencies. The introduction of the fifth AML directive marked a significant step in addressing cryptocurrencies, providing a solid foundation for the introduction of regulations. The fast-paced evolution of crypto assets has posed challenges in managing user risk for regulatory authorities, but the current crises may finally prompt regulators to catch up with cryptocurrency. One could even view the current crypto winter as a necessary step for cryptocurrencies to realize its true potential, weeding out weaker projects overly reliant on poor fundamentals and media hype. Cryptocurrency's cyclical nature suggests that the long-term impact of the current situation may be limited. Looking back at 2022, we can see it as a year of failed legislative approaches for crypto, while 2023 could be the year of cryptocurrency regulations. Clear and definitive legislation is necessary to create a safe and stable marketplace for all participants and foster cooperation between governments, regulators, and digital asset firms. This will enhance trust in cryptocurrencies and establish a level of stability in the industry.
While the European Union is trying to come up with an entirely new crypto asset regulation, the United States is tailoring existing laws to the needs of the newly emerged crypto markets. Just like the EU, the US focuses more on the crypto asset service providers than the crypto assets themselves. In the EU, all CASPs essentially fall under the scope of the MiCAR and the TFR, whereas in the US, it depends on the cryptocurrency in question, duration of crypto assets held, and the outcome of the Howey test. Common goals, however, include investors' protection, preventing fraud and tax evasion, reducing the environmental footprint, and of course, preventing this market from being used for the money laundering and terrorist financing purposes. The common challenges lies in maintaining a reasonable balance between law enforcement and fostering entrepreneurship and innovation. The US legislation surrounding cryptocurrency is not as strict as in the EU, but it is expected that the US will take on a harder approach in regulating this market. In one best scenario for 2023 and beyond, regulators around the world might come together on a global framework for crypto regulation. However, that looks unlikely today, since international views of crypto range from Bitcoin is an official currency in El Salvador and Central African Republic, to crypto transactions are illegal in China. Global unity on the issue seems unlikely in the short term. Even though perspectives may differ, strong regulations can be important and necessary to foster the industry's growth. From the investor standpoint, having access to this new asset class through regulated entities and investment funds help mitigate the risks and prevent the market from being used for criminal activity. But overly radical regulations may have a negative impact. Overall, the future of crypto is uncertain but exciting. The market is constantly evolving, and it will be interesting to see how cryptocurrencies continue to impact the world of finance, and if the regulations are fostering the success of crypto or the exact opposite. Would it be the collapse of crypto? Thank you all for taking the time to join us for this webinar. We hope you found it informative and insightful.
Thank you very much, and enjoy the rest of your day.